The way many people invest in the stock market is dead wrong, and it's costing them thousands every month. While most investors are gambling on the next Tesla or Nvidia, a group of smart investors is doing something completely different. They're not chasing gains, they're collecting checks every single month. I've analyzed hundreds of ETFs, dividend portfolios, and income strategies. And here's what separates the wealth builders from the wealth chasers. One group is still hunting for screenshots to post on social media. The other is building portfolios that pay them while they sleep. The problem? Most people are addicted to the thrill of stock chasing. Social media glamorizes trading like a sport, screenshots of 300% gains, Lamborghinis, and overnight wins. But what you don't see? For every winner, hundreds or more lose money. Over 90% of day traders fail to beat the market, and every month you spend trying to time the next big one, you're bleeding opportunity. You're missing out on income that could be compounding quietly in the background, growing itself without you lifting a finger. Today, I'm showing you 5 high-yielding ETFs that pay monthly. Not quarterly, not annually, monthly. And stick around for number 5. It uses a unique strategy that actually protects your downside during market crashes. Most dividend investors receive income 4 times per year, but monthly dividend ETFs change the game by paying every 30 days. This isn't just about convenience, it's about psychology and compound growth. When you receive dividends monthly, you can reinvest them more frequently, accelerating the compounding effect. Monthly payments also create better cash flow for people building passive income. If you're trying to replace your salary with dividend income, monthly payments align much better with your monthly expenses than quarterly lump sums. But here's the secret that most investors miss. The best monthly dividend ETFs don't just pay higher yields than traditional quarterly payers, they often provide better total returns because of their sophisticated income generation strategies. Let's take a look. ETF number 1. JEPI, the Covered Call King. The JP Morgan Equity Premium Income ETF is the gold standard for monthly dividend ETFs. With a yield consistently around 7%, this fund combines blue chips with a sophisticated covered call strategy, generating income whether the market rises, falls, or stalls. JEPI's genius is holding a diversified portfolio of large-cap US stocks similar to the S&P 500, but also selling call options against them every month. Those option premiums become extra cash for investors on top of the stock dividends. JEPI can pay you 3 ways: dividends from the stocks, option premiums from the covered calls, and potential capital appreciation if the stocks rise. Distributions typically range from 40 cents to 50 cents per share monthly. For a $50 stock, that's nearly $6 per year in dividends, a yield that crushes most individual dividend stocks. The fund is managed by the same JP Morgan investing experts who handle billions for pensions and endowments. You get access to institutional-level expertise for the cost of a simple ETF. Keep in mind though, JEPI will underperform during big bull market rallies because the covered calls cap some upside potential. But if you're after income rather than stock appreciation, this trade-off makes perfect sense. ETF number 2. QYLD, the Nasdaq Income Machine. The Global X Nasdaq 100 Covered Call ETF takes JEPI's strategy into tech territory and supercharges the yield. With yields consistently above 10%, QYLD is popular among income investors who want exposure to tech giants like Apple, Microsoft, and Tesla, but also want substantial monthly cash flow. QYLD's approach is beautifully simple. Own all 100 stocks in the Nasdaq 100, then sell call options on the entire portfolio monthly. The high volatility of tech means those options fetch high premiums, translating into higher yields and strong monthly dividends for you. But here's what most people don't know. The fund has consistently delivered these high monthly payments for years, a feat most individual dividend stocks can't match. The catch? Covered calls cap the upside. When tech surges, QYLD lags. But when markets flatten or fall, QYLD shines, making it ideal for investors who value consistency over chasing highs. ETF number 3, XYLD, the S&P 500 Income Generator. The Global X S&P 500 Covered Call ETF brings the covered call strategy to the broader S&P 500 index. With yields typically ranging from 8 to 10%, XYLD offers monthly income while providing exposure to America's 500 largest companies. XYLD's attraction is its broader diversification compared to QYLD. It spreads risk across all sectors of the economy: healthcare, finance, energy, consumer goods, not just tech. This can provide more stability during periods when any single sector is struggling. XYLD's monthly distributions have shown impressive consistency, rarely fluctuating more than 10 to 15% from month to month. This predictability is invaluable for investors who are using dividend income to cover living expenses or who want consistent cash flow. ETF number 4, DIVO, the Dividend Growth Enhancer. The Amplify CWP Enhanced Dividend Income ETF takes a different approach. Instead of using covered calls across market indices, DIVO takes high-quality dividend stocks and writes call options selectively to enhance yield. The fund targets companies with strong dividend histories and solid fundamentals, then writes covered calls when market conditions are favorable. This flexibility allows DIVO to participate more fully in bull markets while still generating enhanced income. With yields typically ranging from 5 to 7%, DIVO offers a middle ground between traditional dividend investing and aggressive covered call strategies. The fund's holdings include many dividend aristocrats and high-quality companies showing dividend growth for decades. DIVO's active management approach is another bonus. Instead of mechanically selling options every month, the fund's managers optimize the timing and strike prices of their option strategies. This can lead to better risk-adjusted returns over time. If you want higher yields than traditional dividend ETFs, but don't want to completely sacrifice upside potential during strong bull markets, DIVO is for you. ETF number 5, NUSI, the Downside Protection Specialist. The Nationwide Risk Managed Income ETF combines monthly income generation with downside protection through a sophisticated collar strategy. Yielding around 6 to 8%, NUSI doesn't just focus on generating income, it also protects against major market declines. NUSI's strategy is threefold. It owns Nasdaq 100 stocks, then sells covered calls for income, and buys protective puts for downside protection. This creates a unique risk-return profile that appeals to conservative investors who want both income and capital preservation. The protective puts limits NUSI's losses during major market declines. Some of this fund's upside potential may be capped, but it also won't experience the full downside during bear markets. During the 2020 market crash, NUSI's protective puts significantly limited losses compared to the underlying Nasdaq 100. While the index fell over 30%, NUSI's decline was much more modest, roughly 10%, demonstrating the value of the downside protection. The trade-off? NUSI's monthly distributions can be more variable than pure covered call funds because of the protective put strategy's ongoing costs. But many investors see this as a fair compromise in return for downside protection. But the real power of these monthly dividend ETFs comes from combining them in a diversified portfolio that generates consistent income while managing risk. Instead of putting all your money into one fund, smart investors create a blend that provides multiple income streams. A balanced monthly income portfolio might allocate 30% to JEPI for broad market exposure with professional management, 25% to QYLD for technology exposure and higher yield, 20% to XYLD for S&P 500 diversification, 15% to DIVO for dividend growth potential, and 10% to NUSI for downside protection. This allocation provides monthly income from multiple sources while spreading risk across different strategies and market segments. If one fund experiences temporary challenges, the others continue generating income. But remember, these ETFs work best as part of a broader investment strategy, not as standalone solutions. Use them to complement growth investments in a well-balanced portfolio. And don't forget, compounding is where monthly dividend ETFs become truly powerful. When you reinvest those monthly payments, the compound growth effect accelerates dramatically compared to quarterly dividend stocks. Let's say you invest $100,000 in a portfolio of these monthly dividend ETFs, yielding an average of 8%. That generates $8,000 in annual dividends, or about $667 per month. If you reinvest those monthly dividends, you're buying more shares every month. Those shares generate more dividends, which buy more shares. This monthly compounding can add significant value over time compared to quarterly reinvestment. After 10 years of monthly dividend reinvestment, that $100,000 could grow to over $220,000, with the portfolio generating almost $18,000 in annual dividends. After 20 years, you could be looking at over $490,000, with annual dividends exceeding $36,000. The key is starting early and staying consistent. Every month you delay is another month of compound growth lost forever. Look, I get it. Chasing stocks feels exciting. It scratches the same itch as gambling, especially when social media makes it seem like everyone else is getting rich from stock picking. But the truth is, wealth doesn't come from adrenaline. It comes from consistency. And the reality is that while others are chasing hype, the smartest investors are quietly building portfolios that pay them every month. These 5 monthly dividend ETFs represent a completely different investing approach. Instead of hoping for capital gains that may never come, you're building a machine that pays you consistently while you sleep. You can keep betting on the next big winner, or you can start collecting reliable monthly income that compounds for decades. So the question is, which side of that trade do you want to be on? Drop a comment below and let me know which of these monthly dividend ETFs interests you most. And if this video opened your eyes to the power of monthly dividend investing, smash that subscribe button and hit the notification bell. We're going to keep showing you the strategies that actually build wealth, not the ones that just make for good social media content. See you at the next one.